let's go ahead and get started. So this is Beth from Spari, and we've been receiving so many messages from people that are saying, what's going on with the stock market? You know, what should we do? How should we invest our money right now? Should I be selling everything and getting out of the market, and what should we be doing? So we wanted to hold this special call just to give people some guidance on this. So I'm going to talk for probably about, 10, 15 minutes, and then we'll open it up to questions for anyone who has questions. So I've started with a chart. It just happens to be that it was created by BlackRock, which is an investment company. I don't represent them. I just like the chart. And so what this line shows is that if you had invested $100,000 starting back in December of 1994, so that's the bottom left of the graph, and had invested that money in the S&P 500, and again, the S&P 500 are the 500 largest companies in the U.S. So if you had invested $100,000 in the S&P 500 companies starting in December 1994, and fast forward 20 years to December 2014, that's how the assets would have grown over that time. They would have grown to be almost $700,000, about $650,000 during that time. And the reason why I'm showing this slide is because there's very, very typical emotions that go on at different points in the market. So if we start at, so if we look along the bottom, the horizontal axis, so if we look in between where it says December 2004 and December 2009, so we're going to be looking at right around where it's 2007, and you'll see where it says euphoric. So we had hit a nice high in the market at that time. Everyone was so excited, and at this point, everyone was saying, okay, I want to buy more stocks. But then what happened all of a sudden was that we had the bank crisis and the financial crisis. And so we saw the market start to pull back. And then people start feeling surprised and nervous and worried, and then at the very bottom, panic-stricken. So the biggest issue that I had seen with people during this time is they were selling their investments just at the point when the market was at the lowest. Now, for some of you, you may know that my father has been in the financial industry for a while, and there's one thing that he has always told me about investing in the market, and that is that you buy when things are low and sell high. And so what happens is when people are most inclined to sell, because it's when they feel the most fear and the most panic, is almost always the absolute worst time to sell. And the opposite is true. When everyone's feeling so excited and like nothing can go wrong and the stock markets are doing great, that is sometimes the worst time to buy, even though people are more than likely wanting to buy more investments at that time. So again, at the bottom, after panic-stricken, then the market started to come back, and people feel then defeated and cautious, and then they start to get hopeful, encouraged, positive, confident, thrilled, and euphoric. And you can see where it had hit a very high level in December 2014. Let's look at the next slide next, because I want to bring this into perspective a little bit. One of the worst mistakes, again, that I see people do is they buy and they sell at the wrong time. And so again, what happens is that they want to buy when the market's high and doing really well, but then they want to sell when the market is down, and so they lose money at that point. And this chart shows this very, very well. So this shows in 20 years, the furthest left bar shows if you had just invested in stocks. During that time, over 20 years, you would have averaged a 9.9% rate of return. And then we go to the next bar. If you had just invested in bonds, held those bonds, you would have received a 6.2% rate of return, and so on and so on. But if you go to almost the furthest to the right, and there's a purple bar, and that is how the average investor performed during that same period of time, and that's 2.5%. So the question that you may be thinking is, why is it that if someone was just going to go out and buy stocks and just leave them alone and do nothing, they got 9.9%, but the average investor only received 2.5% return in the same period of time. And that is because of what I mentioned earlier, is because investors tend to sell at the wrong times. They sell when the market is down, and they tend to buy at the wrong time. So they do the most buying when the market is high. So I want to put that in a little bit of perspective of where we're at right now. So there's really three things that have been driving the issues in the market. The first has been, and when I say the market, I mean the U.S. stock market. So the first one has been everything that's been going on in China. There's been a lot of issues with their currency. There's really, I think there's just been a lot in China that has been sort of just brushed under the rug for a long time, and now it's starting to come out. So that's one of the things that's creating issues in the market. The second one is the decreasing price of oil. And the reason that the price of oil is decreasing so much is because the Middle East is flooding the market with so much oil that there is so much oversupply, and so the price of it is going down. And the third reason that the stock markets haven't been acting great lately is because investors, their expectations have not been met. Now, even with all three of those factors in place, I do not believe that we're on the verge of another recession. There's many reasons why I believe that, but a very practical reason. So many of you may know I live in Chicago, and I'll tell you there is no lack of development going on. Businesses are opening up. We always say you can judge if we're going on a recession if how the parking lot at the mall is looking. And so I can tell you that is all looking good. And we do know consumer spending numbers that we've seen recently they're good. They're not great, but they are good. So I do not believe that we're on the verge of a recession. I think there are several factors going on that are creating an amount of fear in the market, and that the stock market is acting negatively because of that. So I want to quickly again come back to the slide and finish the point that I was doing earlier. So again, if someone had just invested in stocks for the long haul for 20 years and did nothing, they would have had 9.9%. But when we react to these movements in the market like what we're having right now, then we see that the average over a longer period of time is much lower. The average investor gets about 2.5%. So let's take a look at, I have one more slide here, and then I'm going to talk a little bit about some of the things I think that we need to be looking for right now. And this also, because I've had a lot of people, they say to me, Beth, shouldn't I just put my money in cash or in bonds, or, this just seems like this is, too risky for me. Well, this shows from 1926 out to, I believe this goes out to 2014. And so the dark blue line shows small cap stocks, so that means small size companies, and the teal line shows large caps, so large size companies. So you can see that there's more ups and downs with those stocks, but over time they perform better. Whereas you look at the green line, which are treasury bills, so that's one of the safest investments that you can have. And when you purchase into a money market, a lot of times those are backed by treasury bills. And so you see that green line over time, yes, there's not the ups and downs, but the return potential is usually not as great. So for most of the people who follow SPARI, most people are younger. And so my recommendation still for younger people is to stay fairly invested in the market. Now, and when I say the market, I mean the stock market. So I want to talk a little bit about some of the things that I'm watching very closely, because I will say, even though I don't believe that we're on the verge of another recession, I am a little bit concerned that we could potentially see further losses this year in 2016, that we're not at the bottom. There's really mixed data right now, and so I keep thinking every week that I will have a lot of clarity on it, and I do believe there's some key numbers that I'm looking at this week, and I'll tell you about that. But I think there's a lot to be told in the next week or so of the direction of the stock market for 2016. So some of the things that need to happen in order for the market to bounce back. Number one is the U.S. economic data needs to stay firm, and at the same time, the Fed needs to be conservative with their interest rate increases. So what that means is when we talk about U.S. economic data, we're talking about numbers such as employment, and employment numbers have been looking better lately. And so we're looking at that. Not only are we looking at the number of people that are employed, but we're also looking at how much those people are making. So it's a really important number. Some of the other numbers that are really important to look at are the manufacturing numbers. Also the consumer markets are really important to look at. So those are some of the economic data, and that needs to stay steady, if not improve somewhat, in order for us to recapture a lot of these losses that we've had. And at the same time, as most of us know, the Fed raised interest rates for the first time about a month ago. And so in order for us to bounce back from these losses, these stock market losses, we need to see that the Fed, that they don't take a more aggressive approach than they have. And so the interest rate increase was completely fine a month or so ago. It was long overdue. They should have done it, and it will be fine if the Fed continues to raise rates, but they need to do it at a very conservative pace. All signs show that, yes, the Fed will do that at a slow pace. The second item that needs to happen in order for our markets to bounce back is there just needs to be clarity on Chinese policy. So the Chinese have tried to put in some pretty elaborate schemes in order to reduce the fluctuations in their own stock market, and some of them haven't worked so well. And so there needs to be a little bit more clarity on the direction that China is coming, or the direction that China is going. And so that is something that we're looking for as well. The third item that I'm looking for, and this is the one that is right now what I'm looking at, and this has to do with bank earnings. So these are companies such as JP Morgan Chase and PNC and Citi and Bank of America, all those large banks. And so right now, it's really important to look at what their earnings are. So that the earnings and looking at the profitability and all the numbers of those companies is what I'm looking at right now. About half of the larger financial corporations, bank corporations, have issued their earnings. And out of those, I believe that 3 of them have outperformed investor expectations. And actually, now that I think about it, I think there's probably more like 7 or 8 who have released earnings, because there's 3 that have outperformed what the investors expected. There's about 3 or 4 so far that did exactly as was expected, and there's about 2 who have underperformed expectations. And so there's going to be several more banks issuing their earnings over the next week, and so I'm watching those really closely, because it would be a good sign to see more of them come in over what their expectations were. Would be a great sign. So again, there's 3 things that I'm looking for to show that that maybe we've hit near term a bottom. And again, that has to do with U.S. economic data, including how the Fed raises rates. And the second one is China, and the third one has to do with bank earnings. And I would say the bank earnings one is a short term that I'm looking at. The first 2 are something that will be continued to be monitored over the upcoming months. So the question is what to do about all of this. Again, for most of our clients of SPARI, our clients are young. And so really my recommendation is don't do anything. Stay invested, because the problem is that if you were to, it is just as detrimental to miss out on a recovery in the stock market than it is to participate in the downside. So let's say that we have hit a bottom, and that we don't have much further down to go, and you go ahead and you sell now. Then when the market comes back up, you're losing out on all that growth. So not only did you lose all the money when the market came down, but you're losing out of so much growth as the market is recovering. So for most people, I recommend for them to stay the course, especially with the assets that are designed for longer term. So retirement assets and even college planning assets. And again, a few things. Remember that bar chart that I showed you that, if the investor had just stayed invested in the stock market, they would have averaged 9.9% rate of return versus the average investor only received about a 2.5% return in the same period. So again, it has a lot to do with when you need the money. So if it's long-term money, stay the course. If it's short-term money, so if you are saving money because you want to buy a house, or things like that, coming up soon, that's when you might want to be a little bit more cautious. However, I would watch to see how the market performs this week. If we're starting to see more, the market has come down to some pretty key levels at this point, and if it goes down much further, then that is a sign that there is more downside to come. And so if you see that happen, I would recommend for you to go ahead and move your investments out of stocks. You may just park it in cash, or right now I'm really liking a lot of intermediate term municipal bond funds for shorter term money. So again, if it's longer term, stay the course. For your kids' 529 plans, hopefully you've chosen an age-based option that becomes more conservative as they get older anyways. So stay the course with that if that's the case. And again, it's a little bit more of a tricky situation for people who have more immediate needs. But you can also be sure to send me an email. I'd be happy to answer your questions individually on that. So with that, let's see, are there any questions out there from anyone?
Beth, I have a question.
Yes.
Are you watching the banks just because you're waiting to see if companies are going to default on their loans, and having the small companies default on their loans more quickly usually is an early sign that the economy is struggling more than what we expect?
Yes, absolutely. So there's some concerns about, most of us know that a lot of the recession that we encountered in the last decade had been spurred by a variety of reasons, but part of it was loan defaults. So that's part of the reason that we're watching the financial stocks so closely, is because they are an indicator of a larger theme going on throughout the market. What other questions are there? Well, with that, then, I will wrap up. And if you had other questions that you didn't have a chance to ask, again, email me, or I think Emily's going to be posting this. You can write comments down at the bottom of the page. We'll be sure to answer back. So I just want to thank everyone for coming out to this call tonight.